Welcome to the Real Estate Espresso Podcast, your morning shot at what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about how to time the market. This is a question I get often from listeners. It's also an argument that I hear from those who see value in staying invested in the stock market. They say all you need to do is time the market appropriately. Now, there's two aspects of timing the market. There's the month-to-month timing, then there's the real-time minute-to-minute market timing. The pandemic changed a lot of things in our society and in business. After 2 full years, it's easy to conclude the current situation is the new normal. Well, just as quickly as things changed at the start of the pandemic, things can change again. That doesn't mean a return to 2019. Things never go back. There will be a new normal. It means that you as an investor need to make a bet on those trend level changes and time the market accordingly. Some have argued that if you got out of the market in 2020, as many advocated, including myself, you would have missed the pandemic-induced fall in the market, but then you would have also missed nearly 2 years of run-up in stock market valuations. Clearly, the first quarter of 2022 has been less than stellar in the stock market. Well, this week, the industry leader in telemedicine, a company named Teladoc, posted a huge surprise loss for the quarter, leaving many to wonder whether the growth of the company was strictly a pandemic play. The company was expected to deliver a modest loss of 60 cents a share. During the first 3 months of 2022, Teladoc posted a loss of $6.67 billion, or $41.58 a share. That's a huge miss. The shares dropped 38% on Wednesday night, and Cathie Wood's ARK Invest Fund is staring at a loss of nearly $400 million overnight. The fund is the largest shareholder in Teladoc with more than $1 billion invested. The fund has been steadily acquiring shares until as recently as a day before the announcement. In a statement, Cathie Wood was quoted as saying that investors have it all wrong. Teladoc is the market leader. They're the backbone of the entire telemedicine trend. They're effectively the only game in town. They're the Amazon of the medical field. Now, whether she believes in the company or not, the company still delivered a huge surprise to Wall Street with no prior guidance, and for that, the stock deserves to be punished. Remember how the FANG stocks were the technology engine powering the stock market. FANG is an acronym that stands for Facebook, Amazon, Netflix, and Google. The wisdom was that if you invested in these 4 FANG stocks that underpin the tech sector of the stock market, you would do well. So let's look at that. Facebook has fallen nearly 50% to $180 per share since its high of $346 less than 6 months ago, before rebounding to $210 in recent days. Facebook has been a growing company with strong ad revenues on its Facebook and Instagram platforms. They've been a fast follower in the space and added features to blunt the advance of new entrants like TikTok and Snapchat. But they still are consumed with trying to develop a long-term growth strategy, hence the metaverse thrust for the company. They've been blowing billions of dollars per quarter developing technology for a nascent market that has yet to become mainstream. We have Amazon, who posted its first quarterly loss since 2015. Expenses have grown as a result of the company's rapid expansion. I'm not expecting any layoffs at Amazon. At least not anytime soon. They have very high employee attrition, so if they need to reduce headcount, they just need to slow down hiring and wait. Amazon has lost 38% of its value as a result of its financial performance. The pullback at Amazon is a result of softness in its core business. Revenues are up, largely due to inflation, but package shipments are flat and in some cases declining as shoppers return to bricks-and-mortar retail. Netflix has lost several 100,000 subscribers in the past quarter, compared with a projected gain of 2 million. Some of that subscriber loss was due to the war in the Ukraine. Netflix canceled nearly 700,000 accounts in Russia shortly after the war started. The result was a 72% fall in share price from its highs less than 6 months ago. Rounding out the FANG group of companies is Google, now renamed Alphabet, and while earnings have remained robust at Google in its core search business, the stock is also down 23%. The impact is due to a loss of subscribers on the YouTube platform. The narrative over the past 2 years has been that the stock market is the place to invest. But if the price-to-earnings multiples have been insanely high on a fundamentals basis, many have acknowledged that PE ratios were way too high. See, Google's parent Alphabet today is trading at 20 times trailing earnings. That's the same as saying a 5% cap rate in real estate terms. A 20 times multiple seems incredibly reasonable compared with valuations we've seen over the past 2 years. Basically, these stocks were priced to perfection. It would have taken nothing short of perfection to maintain those valuations. When prices fall, they fall quickly. The drop at Netflix was slowly at first, then all of a sudden. The stock dropped $100 per share in a single day in January, then another $110 in a single day in April. When the earnings announcements happen, they're outside the core hours of the stock exchange, but the futures markets remain active overnight following the announcement, and the shares open lower at the opening bell the following morning. You have zero chance to time the market. Same is true for all the other stocks that I mentioned in today's episode. Anytime you invest, you're making a bet on the future unfolding with a set of assumptions. But some bets are more speculative than others. When we invest in real estate, we don't expect to see a massive value fluctuation in a single day. And while real estate doesn't have the same liquidity as the stock market, you have time to notice changes in the market and make adjustments in the portfolio. You have the opportunity to prune the portfolio of underperforming assets and to accumulate better performing assets. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.